Good Monday morning to you, everybody. This is Lee Goss coming at you again from the offices of International Futures Group and EFG Group here in Chicago. I want to talk to you about several commodities that caught my eye this weekend as I was working on the LAWG 647 model. As some of you may know, all my recommendations, comments, and projections are based on the LAWG 647 model, and while it's not perfect, I have a great deal of faith in it. One of the commodities I want to talk to you about today is March corn. Now, March corn, when I came in for filming, was trading at about $3.90 a bushel. A close at or above $3.95 this Friday will reverse the trend to bullish. And I also expect a greater or an increased degree of volatility over the next 5 days, especially as we get later in the week. One of the things you may want to consider is if we get above the $3.95 level, you may want to think of a short-term sell of that price above $3.95, looking for the market to suck back towards the $3.95 level, which could become a very volatile battleground price for the week. The other commodity I want to talk to you about today is the May cotton. Now, May cotton has been close to turning the last several weeks. If May cotton closes at or above 61.08 on Friday, then we're going to see May cotton reverse from bearish to bullish. I don't really have a great deal of anxiousness to get involved in the cotton market presently. I'd like to see some sort of confirmation. If I was forced to do something, I would probably sell a larger rally. Cotton is very close to running into some pretty stiff resistance and is still below the 200-day moving average. But if we can get a close at or above 61.08 on Friday, it will reverse the trend. The model will reverse the trend to bullish. One of the things I do want to talk to you about also, because it's very interesting, at least it is to me, is April cattle. April cattle are in a long-term downtrend, and it's going to take a close this Friday at or above 164.30. And when I came in here for filming, April cattle were trading at 153.80. So we're a good ways away from seeing a reversal to the bullish side in the cattle. But the thing that caught my attention was the August-April cattle spread. Now, I keep just some indiscriminate back month type of spreads in most commodities just to see if they give me a signal, an early indication that we might see a trend change in the upfront commodity itself. Now, what I'm seeing is that if the April-August or August-April cattle spread close at or above $8.07 premium the April, this Friday, it's going to reverse the trend to bullish. Now, one of the things that interests me is that about 10 weeks ago, exactly 10 weeks ago, that spread reversed from being bullish the April, bearish the August, to bullish the August, bearish the April. And the thing that's interesting about that is that the April cattle turned bearish 9 weeks ago. So we saw that spread preceded the bearish move in the cattle market. Will we see the same thing on the bullish side? I don't know. But I do know that my experience has been that if we see that spread return to a bull spread where April begins to gain and take dominance over the August, I'd be very careful about a short side or a short trade in the cattle. This could be a critical signal. We may find out now over the next week or two, depending upon what that spread does, if the cattle market, feeder cattle market, are indeed over, or have they just taken a rest from some very high levels, and we may be setting ourselves for a return to those areas. Now, one other spread I want to talk about just briefly is the cattle hog spread. The April cattle April hog spread when I came in here was trading at about $87, which is some unheard of values. I don't know if we're going to get a reversal before the Aprils go off the board. I just know that if we do get a reversal when the Aprils go off the board, if the model tells us we reverse the trend, I'm going to be aggressively looking at buying the hogs, selling the cattle. because this thing is so far above historical levels that you've got to think that if the trend ever turns, there'll be some pretty good opportunities. But of course, then again, it is my opinion. In fact, all of these are my opinion based upon the data from the LAWG 647 model. Keep in mind, whether you're trading futures, options on futures, or spreads, there's risk involved. It is risky to trade futures. It's risky to trade options on futures. And if you're the kind of person that is the first in the basement come tornado season, you probably aren't suited for commodity trading. So until next time, this is Lee Goss signing off. I hope you have a great day and a great trading week. Thank you.